Let's give you the markets update now. The JSE is set for mostly positive session this morning with the threat of COVID-19 and the future of monetary policy still the major themes occupying investors' minds. Jimmy Moyaha is an independent analyst. He joins us now to talk us through the latest market moves and some business stories. Jimmy, very good morning to you. So how have the markets, or should I say, how did the JSE open this morning?
Morning, Chloe. Well, the markets opened rather flat this morning. The top 40 is up about 0.5%. The rand is strengthening at 14.28 against the dollar at the moment. I think if we just look at the performance of the SA40, we saw that August's performance sort of undid the hard work that July's performance put in. July was up about 4% for the month, and August was down about 3.5% for the month in terms of overall trading for that month. But it is important to look at the fact that the equities markets as a whole are sort of performing the same across the board, both locally and internationally. Equity markets are at all-time highs. Investors are sort of piling on into equities at the moment, and that's largely off the back of the fact that interest rates that you're receiving from the banks are very low. So your equity markets at the moment are providing a better return. But as we've said, all the equity markets are at all-time highs, and it's just a matter of time before that starts to retrace, or we start to question how long this is going to be sustainable for. So from the JSE side, we've seen continued good performance on some of the stocks as well. Locally, we've seen Bidvest down 1.3 odd% despite reporting good results. You've got other guys like Naspers up 2%. You've got Discovery up about 1.5%. So overall, in this morning's trade has been a positive start to the week, and we're looking to see if we can claw back some of the gains we lost in August.
Yeah, let's talk about the Iraqi government's deal with Total Energies, which have basically agreed on a $27 billion package of investment deals. Now, these are aimed at boosting oil and the gas output, which is assumed to reduce power outages in oil cartel OPEC's second biggest producer. Talk us through that particular deal.
So this is a fantastic deal for Iraq. I mean, as they stand, they are the second largest producer of oil in the OPEC region. But this is a really good deal for them. It's a 25-year deal worth about $27 billion. And the initial investment is about $10 billion. But there's a couple of things that, looking at the deal, might sort of you want to glance over. Just from an Irani perspective, some of the things mentioned in this deal are that the Iraqi oil producers will be able to also then produce gas or natural gas on their side as a result of this investment by Total. And if we look at that impact and the result of that, they're basically going to be able to produce natural gas at about $1.50 cheaper than what they're currently importing it from Iran at. Now, that's great for Iraq, but what that could do is that could now create tensions politically between Iraq and Iran. Yeah. As we know that Iran's major issue at the moment isn't necessarily that they're unable to produce things, it's the sanctions being imposed on them. And so there's been that ongoing conversation to lift those sanctions from the West for Iran. And I think this type of deal from a natural gas perspective tends to have the potential to be a political situation between Iraq and Iran. They are both members of that OPEC region as well, but it's just going to be delicate on that front. In terms of the oil production itself, this deal would see Iraq be able to increase its output quite dramatically. We do know, of course, we remember a couple of months ago that the UAE wanted to also increase their production output, and the way OPEC is structured is that they're in wanting to control the oil price and wanting to keep that at a certain level, regardless of how much you are able to increase the output, it's going to be capped at how many barrels per day you are able to supply as part of your allocation from the OPEC region. So yes, Iraq is going to be able to produce more. In some cases, they're going to be able to almost double. I think their Artawi oil field is going to be able to go from 85,000 barrels per day to about 210,000 barrels per day. So that's more than double the production there. But again, it's going to be about the OPEC cartel wanting to maintain that price at a certain level, regardless of the production increases.
Let's bring the oil conversation closer to home, Jimmy. South Africa publishing regulations that will lower the sulphur content that is allowed in the country's diesel fuel, which may force some oil refineries to upgrade in order to meet these new standards. These rules are set to come into effect on September of 2023. Talk us through what these new regulations are going to mean for the sector.
So the regulations, I mean, in policy and in principle are really good regulations. We've seen around the world not only a drive for reduced emissions, cleaner energies and that sort of thing, but we've also seen that global players have had to adjust their business models in line with this sort of thing. So the policies themselves and the way that the policy has been drafted is not an issue. It's a good policy. It's been a standing policy for quite some time with our government and with the petroleum and energy sector. The concern now is the timing of the policy and the timing of the implementation. We've just gone through a global pandemic. A couple of years ago in 2018 as well, when this was initially discussed and this was tabled, we saw that the refineries and the producers of oil and petrol locally had decided that this was going to be an expensive exercise. I mean, Engen was one of the first companies to come out and say, well, this is no longer feasible. And they even reconsidered closing down their Durban plant, their Durban refinery, in line with these new regulations, because it would then put the Durban plant in financial distress. Now, the petroleum and gas and oil space, locally especially, given where we positioned in the world, is a very interesting space, is a very delicate space in that while you want to achieve good production and you want to achieve good and reasonable and clean production, you also have to look at the fact that we are not where some of the other countries are globally. So you might want to push back the implementation of this new law and these new requirements, because what you could find is that the refineries that are unable to adapt and unable to improve, or that see that it's not financially viable to make these changes, could then close down refineries and then turn them into import destinations. And what that's going to do at a grander scale and looking further down the value chain is you're now going to be importing even more fuel. I mean, we're already struggling with the fact that about 36 to 40% of our local fuel is fuel taxes. And that's now down to a number of factors that the government has said, including this new salient tax that they're now implementing and that sort of thing. So we're already on a very difficult path in that respect. We're paying more for fuel than our neighboring countries that we are supplying with fuel. And now we want to now go into this delicate situation of tampering with the actual production of that. And if you find guys like BP and Engen already saying that their margins are low and they're going to struggle with these new regulations because the environment locally isn't very financially affordable or isn't very attractive for them here, if we see big refineries start to shut down in that respect, we could have a bigger fuel problem with our fuel price increasing more than this is going to create a solution. So again, while the policy is fantastic, there's nothing wrong with the policy itself and the tabling of the policy and the structure of the policy. It is where the global countries are headed. It is where everybody is looking to head to be less reliant on fossil fuels. It's about the implementation. The timing of the implementation, you might want to push that back just a little bit further so that smaller refineries can catch up, bigger refineries can start to weigh up the numbers even more and that sort of thing, particularly as we come out of a global pandemic.
With some company news, Bidvest releasing its financial results and, listen to this, cash dividend declaration for the year ended 30 June. Talk us through their numbers.
Yeah, so they released a really positive set of results. We've got a final dividend of around 600 cents per share. You've got sorry, that was a total dividend. The final dividend was about 310 cents per share. You've also got some trading profit up about 47%. We've seen that their return on capital employed and return on invested capital were all up. Headline earnings per share was up about 113%. So they did report a rather positive set of numbers. They also did cite that sadly they lost about 112 members of their team or of their workforce to the COVID-19 pandemic. And that's always going to be a sad figure to report. And we've seen that our local death toll figures while our recovery rate has been amongst the highest in the world, it's never a good thing to see that death toll increase on a daily basis. So on the Bidvest side of it, though, back to the numbers, they did report really good numbers. Like I said, their revenues were up about 15.4% as well. And they've said that a lot of their business has come from some of the restructuring within to achieve sort of operational efficiencies over the last year, which is what a lot of the companies have been doing as well. I mean, we've seen that, especially with diversified companies that operate in multiple sectors and that offer multiple sorts of services, like Bidvest does, is you've seen certain divisions within the Bidvest group perform slightly better than other divisions, but on the whole, Bidvest's results were very positive for them.
Jimmy Moyaha, independent markets analyst, thank you very much for your time.